I was trying to avoid making this video when all these institutions now saying that the United States is going to enter a recession, but then just a few hours ago, the IMF, the International Monetary Fund, came out and they had a statement and they downgraded their outlook on the economy. And essentially what they say is that the worst is yet to come. Let me give you a statement directly from their chief economist. They say that in short, the worst is yet to come, and for many people, 2023 will feel like a recession. After that, I wanted to cover now what has kind of been the changing trends amongst institutions here in the United States. So you have the IMF now downgrading their outlook for the global economy in 2023. Then just a couple days ago, you had Jamie Dimon, who is the CEO of JP Morgan Chase Bank, come out and he said that we can expect the United States to be in a recession in 6 to 9 months. Around the same time, you had Bank of America come out and they said that you can expect the United States to start losing about 175,000 jobs a month, every month, because Bank of America expects now the United States to enter a mild recession at some point in the near future. So now you have Bank of America, you have JP Morgan Chase Bank, and now you also have the International Monetary Fund essentially downgrading their outlook for the United States and the global economy. So now I want to dive in and talk about what these three different institutions are saying, what you should expect, and what you can do to prepare and take advantage of whatever opportunities might be coming your way. So let me start by talking about the IMF, which is the International Monetary Fund. And essentially, they have downgraded their global growth outlook. What they're saying now in 2023 is that our global economy is still going to grow, but it's going to grow by 2.7%. And before, they said that they expected our global economy to grow by 2.9%. And before that, they expected our global economy to grow by 3.2%. So essentially, they've been downgrading their predictions of how much our economy is going to grow. And then they kind of made this funny statement where they said that there's a 10 to 15% chance that our global growth could be lower than 1% in 2023. So kind of an interesting way to put it. And they went on to say that 2% global growth is, quote, a very low number. What they said directly, I wrote this down, is we have only had 2% growth about 5 times since 1970. And every time we had 2% growth, if you look, it's a 1973 oil price shock. In 1981, it was the Volcker disinflation when they fought inflation and had mortgage rates at around 18%. It was the 2008 financial crisis. And so every time we had global growth around 2%, it was very painful. And it was a time of a lot of volatility. It was a painful time for our economy. And so they're saying if we do see 2% in 2023, you can expect that to be a momentous time in our economy, because that means you're going to see a lot of pain here. The number one contributor that they're talking about isn't just inflation. It's the Russia's invasion of Ukraine, because that's continuing to destabilize our global economy. And in addition to that, we're already seeing Europe that's facing this major energy crisis that's going to continue to become a bigger problem in 2023. And in addition to that, it's inflation, which is kind of the icing on the cake, which is pushing our world economy and our countries into a deep recession. And they said, hopefully this will be a soft landing, or even if it were to be a recession, it could be a shallow recession. So still a lot of hopes that it's not going to be that bad, but you're starting to see more and more institutions start to have more of a downgraded outlook about what's happening. Because 6 months ago, everybody said, no recession. How could we see any sort of slowdown? Everything is great. Inflation is under control. Now, inflation is not under control. We're also going to get more inflation data tomorrow. And we're also hearing that our economy is slowing, so be prepared for that. The last warning that the IMF gave was to the risks of stability of the global financial system. What they said is that the global financial system stability has, quote, materially worsened. And they're saying that market liquidity has been deteriorating across key asset classes. And there's a heightened risk of rapid, disorderly repricing, which could interact and be amplified by pre-existing vulnerabilities. I know that's a mouthful of words, but essentially what that means is that we've been seeing the price of assets fall, and that we could see dominoes fall, causing asset volatility, asset prices to fall, real estate, stock market, cryptocurrency, business valuations. We could see those all crash essentially quickly because of all the risks that are happening. And so they're saying that we're seeing a higher chance of this type of correction or crash because of all the issues that are happening, not just here in the United States, but across the globe in terms of the war, energy, slowing economies, and inflation. Now, before I go on to what JP Morgan said with Jamie Dimon's statement, I do want to let you know that we are covering all of this stuff in market briefs. If you're an investor, if you want to stay up to date on what's happening in the financial markets when it happens, that way you can make better decisions with your money. Market briefs is a free tool that I created where every day my team is breaking down what's happening in the stock market, the real estate market, crypto, inflation, and the global economy into a fun, witty, and easy to read email. I promise you, even if you're not a financial person, you're gonna love reading market briefs because we make it so entertaining. We make it a fun email while also keeping it very educational. So if you haven't joined market briefs yet, it's completely free. And I got the link to how you can join market briefs down in the description below. This brings me now to Jamie Dimon's statement, where he said the United States economy is, quote, actually still doing well. But what he's saying is we don't want to look at our economy where it is today, but rather look at the economy at where it is going. And he's saying that, well, we are in better shape today than we were before the 2008 global financial crisis. We still have some negative headwinds ahead. He says that you can't look at the economy without talking about all the stuff in the future, and that is some serious stuff. And he's saying that there are some things that could likely push the United States and the world into a recession. And he says that Europe is probably already in a recession. He says that the United States is not in a recession right now, but he's saying that the things happening in Europe, meaning the energy crisis, meaning the inflation, the economic slowdown. I've made videos talking about this. If you are not familiar with what's happening in Europe, you can join market briefs and watch some of my videos on it. But he's saying that these things are also going to contribute to pushing the United States into a recession 6 to 9 months from now. So sometime in the early to middle part of 2023, he expects the United States to be a recession. And then he was asked, how bad is this recession going to be and how long is it going to last? And he says that we have no way of knowing how long it's going to be or how bad it's going to be, but it could range. According to him, he said, quote, it could go from a very mild to quite hard, and a lot will be reliant on what happens with the war. So I think to guess is hard, but be prepared. So his advice is be prepared. And then the last entity that I want to talk about is Bank of America, who says that they are expecting the United States, or they think that the United States could lose up to 175,000 jobs a month. Why? Because of the rising interest rates. The Federal Reserve Bank is working to raise interest rates to fight inflation. These higher interest rates hurt businesses. They make it more expensive to borrow money. They make the debt that you already have more expensive, so they increase expenses. And these things are going to increase unemployment. And Bank of America says the unemployment will then peak at 5.5%. Now, to put that in perspective, we are under 4% unemployment right now. We're at 3.7 or so percent unemployment. And when we had the 2008 financial crisis, in 2008, we had peaked at around 10% unemployment. So according to Bank of America, now they've kind of changed their tone. They're now saying that they expect the United States to see some sort of, quote, mild recession in 2023, but they don't expect it to be that bad. They say it will likely be shallow, and they're expecting unemployment numbers to peak at around 5.5%. Now, the thing that I want to really highlight amongst everything is you got to take everything that you hear with a grain of salt. And the thing that you want to pay attention to is the trends, because like I said earlier, 6 months ago or 9 months ago, every single one of these entities said no recession. Everything is under control, no economic slowdown. Things will continue to boom in 2023. Then 6 months ago, the same thing. They said maybe we might see a little bit of a slowdown, but it will continue to be a boom. We're not going to see any sort of rise or significant rise in unemployment. 3 months ago, that's when you started to hear a little bit more of slight worries of the economy, but it was still under control. Now, as of like mid-October 2022, this is when now you're starting to see more and more institutions talking about, okay, yes, we predict a recession. Yes, we predict more layoffs. Yes, we predict more economic pain. but it's not going to be that bad. So you got to just kind of understand the trends, because 3 to 6 months from now, chances are all these institutions are going to come out with new statements, new opinions. And so you got to understand what's happening. And this is where the best advice is actually Jamie Dimon's advice, which was be prepared. Be prepared, meaning have cash, have money, have capital put aside to protect you from a recession or whatever it might be, but also to take advantage of opportunities, because the reality is more millionaires are made during market crashes and recessions than any other time. I have a ton of videos that talk about how to actually invest and how to find opportunities. So you can check those videos out. But this is where understanding that if you do see a downturn, it creates opportunity for you to buy some of these assets at a discounted price because people will be selling. And second is to start getting educated now, knowing what it is that you want to invest in. If you've been looking at investing in real estate, how do you find good opportunities? Start looking for YouTube videos, start looking for classes, start reading books. If you want to invest in stocks, the same thing. Start taking classes, watch YouTube videos, read books. If you want to buy businesses, same thing. Start researching. This is the time you want to be learning, because, things are okay. Gas prices are high, inflation is high, the economy is starting to hurt, but relatively, things are still okay. They can get a lot worse. And you got to understand, we have pain ahead because inflation is high, the economy is slowing, and to fight inflation, we got to hurt the economy more. Like, we have to raise interest rates, which a byproduct of that, a symptom of that, is pain in the economy. And the Federal Reserve Bank is right now saying that they're going to do whatever they need to do to bring inflation down, meaning that they're going to raise interest rates as aggressively as they need to bring inflation down. We're going to get a new inflation report on Thursday. I will be covering that. We'll also cover it in market briefs. But this is where just understanding that, like I've been saying for a year and a half now, the Federal Reserve Bank does not have fairy dust to make inflation go away. And so to make inflation go away, we're going to have to do things like raise interest rates, pull money out of the economy, which have consequences like hurting asset prices, causing layoffs, hurting the economy. And this is where you want to be financially educated, be prepared, because if you've been following what I've been saying for the last 12 months, none of this is a surprise, but this is where you got to just understand that this whole slowdown is happening right in front of us. And this is where you want to be educated and prepared. That way you can take advantage of opportunities that might come your way. In the beginning part of 2021, the Federal Reserve Bank came out and said that inflation is transitory, and they expected it to essentially disappear by the end of 2021. And because of that, they said that there was no need for the Federal Reserve Bank to take any action to bring inflation down. Well, of course, by the end of 2021, we were told that inflation